Hello and welcome. So, after understanding the fundamentals of financial modeling, we understood what are the financial statements. We understood that there are the three statements: income statement, balance sheet, and the cash flow. In the previous, we understood what is an income statement, how we analyze the income statement. If we step forward, it's our current position, and we are learning about financial position. So, first of all, we need to see elements of financial position, a very interesting topic. Financial position is also called a balance sheet, which states the company's financial position at a time. It includes the historical all of the year's result. It states a balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific moment in a time. Yes, we determine the company's financial position where the company is standing at a time. That statement is called the balance sheet. We prepare it using some elements. There are very different and interesting parts of the balance sheet or the financial position. So, the financial position is a crucial tool for understanding a company's assets, liabilities, and equity. The balance sheet offers a point in view of company's financial health, allowing investors, stakeholders to assess liquidity, solvency, and financial stability. So, we prepare a balance sheet for our investors, stakeholders, and management for the decision making. You need to understand the elements side by side and its purposes for the decision makers. We have the different uses of financial statements, and on the list of uses of financial statements, the very first we got the stakeholders or investors, or we got the management to discuss those. First of all, we got to see the assets. There are the different types of assets available. We have a non-current assets and the current assets. The non-current assets, these are the long-term assets like property, plant equipment, and the investment. So they have been used for the longer period than 1 year. You need to understand those things. As I wrote the property, plant equipment, it refers to IS 16 PPE. It's a property, plant, tangible asset. And then we have an investment. There are different types of investment. If we do investment in property, it's called investment property, and we have a separate standard. It's called IAS 40. Similar way, we move towards the financial instruments. These are also the investments of companies. There are different types of investments are discussed in IFRS 9 as well. If we see toward the leases, IFRS 16, we got to use the right of an asset. When we call right of an asset, it is also a non-current asset which we can use for the longer period of time. I hope we will be working together in a financial modeling course, and we will getting an understanding of IFRS 16 as well. It has been mentioned in our coursework and the operational modeling handling. In the current assets, these are explained as assets expected to be converted into cash or used within the 1 year, such as cash, account receivables, and inventory. So we have some current assets. It's number one, account receivables, then number two, inventory. These are readily available to be converted into the cash. The assets which are readily available to convert into the cash or can be used within the 1 year, the benefits limits to the 1 year benefit, those are called current assets. I hope you have understood financial positions asset side. If we move forward, what we get, let us see it. We get to see the equity portion. I hope you remember in your previous sessions of your accounting classes, or you can say your financial reporting, you got to see an accounting equation. That accounting equation represents assets is equal to equity plus liabilities. We discussed about the assets. Now we are moving towards the equity. You can see a slide full of information. Very informative for you. It says equity Equity represents the owners or the shareholder residual interest in a company's assets after deducting liabilities. What does it mean? We understood the accounting equation that assets is equal to equity plus liabilities. Now it's saying that to find the equity, we deduct company's assets, liabilities. Does it make a sense? Yes, it makes a sense. But type here a equation for you to understand. It says equity equals to assets minus liabilities. So this is the equation which is referring. So the owner's residual interest. Residual means the remaining interest in a company's assets. Alright, we understood that. I hope you are understanding side by side. And if you have any questions, you have the WhatsApp group or you have a call option to call me and understand your point. It further states it includes like common stock. Now you are going to see the types of an equity available. Common stock, by the way, common stock is also called ordinary shares, retained earnings, and additional paid in capital. First of all, we got to see the share capital. Share capital refers to the funds that a company raises by issuing shares to the investor. So we are issuing shares to investors to fund for a company's future working benefits or income generations, a beginning point for your business that is called share capital. These shares represents ownerships in a company. Yes, we represent the ownership of a company by issuing the shares to the shareholders, and the capital raised is used for the various business activities. We have a business activities. For the business performing activities, we need some capital, we need some cash or money. That cash or money our company raises from issuing the shares. What are the activities? Some of those are mentioned here, such as expansions, paying of debts, or general operation. So, company can issue further shares to pay off its debts if its profit are not sufficient for paying off the debts. If a company profit is not sufficient, then it will be issuing further shares to generate a cash for its operation working. And if a company want to expand its assets or want to expand its working business operations, then it must be needed a handsome amount of capital. There are some types of capital available. In a front, first of all, you got to see authorized share capital. The maximum amount of capital that a company is authorized to raise through the issuance of shares as stated in its charter or articles of incorporation. Very good point. So, as a type of incorporation of your organization or a company, you wrote your maximum amount which a company issues a shares and your cash at the time of incorporation, at the time of beginning, that is called authorized share capital. Issued share capital, the portion of authorized capital that has been issued to the shareholders. So, yes, we issue some shares to the shareholders, and that a portion, specific portion of a capital is called issued share capital. We have a paid up share capital type as well. It explains the portion of an issued capital that the shareholders have paid for. Often this is equal to the issued share capital if shareholders have fully paid for the shares. Yes, there are some shares which can be paid fully. There are some shares which can be paid lesser than amount and you can start your workings. This is being referring to the portion of a share amount that have been completely paid off. So you would be getting cash replacing your capital, calling the paid up share capital. Categories. So, first of all, you understand what is an equity. You understand your accounting equation relates to equity. You understand what is a share capital. You understand that there are some types of capital being evaluating for you. Now you have some categories. How many types of common shares, or you can say share capital has been introduced. First of all, we have common shares or ordinary shares. This represents the ownerships in a company and usually carry the voting rights. Next, you got to see the preferred shares. Typically, do not have the voting rights but have a higher claim on assets and earnings that common shares, especially in the event of liquidation. Yes, when your company is being liquidated, when your company is being dissolved, when you decided to shut your operations, first of all, you pay off the shares, buy back the shares of a preferred share owners. At the end, you got to see the common shareholders. And this is one of the very interesting difference between the common shareholders and the preferred shareholders. I hope you understand very well about the equity portion. What's the next? You got to see the share premium. It's also called additional paid in capital. What is its definition? So, it is also called additional paid in capital. It refers to the amount received by a company for investors over and above the par value, nominal value of the share issued. Now, you got to see further interesting words, a par value, nominal value. By the way, in Pakistan, as your instructor and I'm in Pakistan, a nominal value of a share is rupees 10. And if a company issues shares above 10 rupees, for example, 11, 12, and the difference between the issue rate and the nominal rate, you got an additional amount. That additional amount goes to the share premium head. It says the par value definition. The par value is a minimum amount set for the shares, and any amount received in excess of this consideration is called the share premium. Yes, we got an excess amount. If the company's nominal value is $10 or 10 rupees, and I'm getting $11 or 11 rupees, the 1 rupee is in excess of a nominal value, and that is considered to be share premium. It would be shown separately. Example, if a company issues shares with a par value of $1 per share and sells them at $5 per share, the 4 is share premium. Yes, we understood that. Purpose. What is the purpose of share premium? Share premium can be used for the company's specific purposes. So these are just common purposes, whether each company's status differs. Each company choose a different purpose for their share premium amounts. Some of the common are paying off debts, issuing the bonus shares, covering issue expenses, it cannot be used for dividend distribution. You need to understand that your dividend distribution can be done through your retained earnings. Those are not the part of share premium or share capital ordinary shares. You need to understand things very deeply. For this, you should have a brief knowledge of IS1 as well. By the way, now IS1 is being changing towards the IFRS 18. At the next, we got to see the retained earnings. Retained earnings represent the cumulative amount of net incomes that a company has earned over its lifetime, minus any dividends that has been distributed to the shareholders. So, you got a net income for the period from an income statement. You refer that income statement value to your balance sheet equity portion, retained earnings. But here it states the very important thing that your cumulative net income is called the retained earnings. But before you call retained earnings, you deduct your dividend from it. It reflects the portion of a profit that has been reinvested back to the business rather than paying off to the shareholder. Yes, you pay some portion of a dividend and the remaining amount which you invest back in your capital, which you invest back in your business operations, which you use for your further operations, which you use for the paying of debts, which you can use for your expansion, that is called retained earnings, or you save for the better times or you save for the bad times, that is called retained earnings. You have also a purpose of retained earnings. It says that retained earnings are often used to finance ongoing operations. Yes, retained earnings are being used for ongoing purposes. I explained previously. We reinvest in our business, we pay down our debts, we got to save the future needs, we purchase the capital expenditures, we can get our long term assets, we can pay our non current liabilities. Calculation. How do we calculate the retained earning? A very basic statement in the front. It says retained earnings equals to beginning retained earnings plus net incomes minus dividends. So if you are the first year of your operation or first year of your company, you wouldn't be having a beginning retained earning. But at the end of your first year, you would be having the net income, and if you have a policy to pay dividend in that year, you will be paying a specific portion of your dividend value. Next, we have liabilities. We understand that there are two types of liabilities, current liability and non-current liability. If we see to a non-current liabilities, these are the long-term obligations like long-term loans or the bonds. If we see toward the current liabilities, there are the obligations that must be settled within the 1 year. Yes, we have a 1 year settled obligations such as current account payables or short-term debts, or we can pay off a short-term portion of a loan. If we analyze the balance sheet, there are different types of analysis. We got to see solvency evaluation, we got to see liquidity portion analysis, we got to see financial stability. Balance sheet is also equally important as we see the income statement. Previously, we understood the income statement. Currently, we are understanding balance sheet and its analysis. At a liquidity position, it explains the balance sheet helps to determine a company's liquidity or its ability to meet short-term obligations. Yes, balance sheet helps to meet the short-term obligations. We can see that what is the current position, current image of account payables, whether we can pay account payable using our current position of a cash, or we can get some further type. Analysis Analysts often focuses on current assets, as I explained you current assets before, and the current liabilities to calculate the ratios like current ratio, quick ratio. These ratios gauge whether the company has enough assets. Yes, if company has an asset that can be quickly converted into the cash, we are very good liquidity position to cover the short-term debts, but it's a vice versa position as well. We need to see all of these things side by side and how these can be related. Just wait for a second. Next, we're going to see solvency evaluation. So it says solvency is an essential aspect of financial analysis. As a part of financial analysis, we get to see the liquidity assessments, we see solvency assessment, we see financial stability assessment. It's very important. You can say it's a compulsory, it's a must portion of your financial analysis. Solvency analysts use a balance sheet to assess companies' long-term financial stability. They look at the non-current liabilities and equity to calculate ratios like debt to equity ratios. So there are many solvency ratios. In a further section, we have a module of financial modeling. We have a module of financial analysis. In that module, we're gonna cover our financial analysis of income statement as well. We got to cover the financial analysis of balance sheet as well as the cash flow. We will be preparing different types of analysis. As you know, there are comparative analysis, there is vertical analysis, there is horizontal analysis. These are just a common analysis you know and I know. As being a financial planning analysis manager, or you can say your tutor for FMVA, I will be developing specific financial analysis models as well. We have a different case studies as well of a balance sheet analysis, of an income statement analysis, as well as the cash flow analysis. But it is not limiting to the cash flows. That analysis is also including your free cash flows valuation as well. So at the end, your last module, corporate finance modeling, it also includes your free cash flow modeling as well as its analysis. Now, I hope you understand how important your course is. It is being developed a long course of FMBA, but it is being comprehensive for you. We do solvency analysis for investment decisions. We do liquidity analysis for our position, whether we can pay the short term debts or not, to see the current positions. Financial stability. A stable balance sheet is a sign of financial well being. Analysts examine the trends of a company's assets, liabilities, equity over the time to identify any unusual fluctuations. A consistent and well structured balance sheet demonstrate financial stability and responsible management. After both liquidity assessment, after solvency evaluation, we got to see the financial stability. We see whether my balance sheet equals or not, whether my balance sheet has a upward trend or downward trend. We've got to see the trend analysis, and it demonstrates our financial stability and the management responsibilities, that whether management performs its duties very well or not. If we look towards any other thing, we can be seeing what are the aspects and what are the different analysis further. Furtherly, we will be working on working capital. We got to see the growth potentials, we got to see the benchmarkings. If we go to see the practical workings, here in the front you have a projected income statement, yet I'm showing you an income statement analysis. I'm not going toward the balance sheet analysis. We will be performing all of this income statement analysis, balance sheet analysis in our course side by side when we will be preparing three statement modeling. Here you see a line chart, and it comprises your years as it comprises your values. You got to see the revenues, your income statement as well, and your net earnings relations. My inflation rate is 17%. If I got to make 21%, you got to see the change in your ratio, the change in your analysis. This is an 20, and any type, this is a scenario analysis of your working. If I make to see the 30%, see my net incomes increases. You need to understand things. By the way, this line chart refers your net income. It refers that if your revenue increases a lot of amount, what is your net income? That is sensitivity analysis and scenario analysis. Here you got to see the line and the column chart as well. Just wait for a second. Yes. Let me zoom out. Yes, now you see zoom out result available in front of you. You got to see the net earnings projections versus inflation. You got to see the difference result. Here you got a table for the projection years 21 to the 24 and its practical demonstration here in the table below. You got to see data validation. You have a shortcut keys available, pressing an alt key, and you got to see further things. I hope you are working and learning side by side with me. This was just a brief analysis of your income statement. I didn't show you your, you can say, the balance sheet analysis, but we will be preparing. As I told you, as I explained, the working capital, here you got working capital schedule in front of you. But wait for seconds. We're gonna develop a comprehensive working capital management schedule for the decision making as well. I'll show you in just a minute. Then we have depreciation, debt interest, all of these gonna be prepared side by side for you. And you will be preparing with me. We got to see the potential growth. If a company grows upward, that's good, and further expansion. If my company is growing downwards. That is an alarming situation. What my working capital management explains. The balance sheet provides us insights how efficiently a company manages its working capital. Effective working capital management ensures that the company can maintain daily operations. Analyst monitors the level of working capital, assess whether it is sufficient to support business activities. We can see the short-term business activities, the working capital dependence. What are my working capital elements? If I type here for you, I have my account receivables, I have inventory, and then I have account payables. This represents my working capital management. For growth, I need to see upward trends or downward trend analysis, benchmarking. We compare companies' balance sheet with the industry best standards, or we got to see the red flags, we got to see the yellow flags working, whether our company is moving upward from the red flags, whether my company is moving toward the green flag that shows the best performance, and if a company is going toward the yellow flags, it represents a middle working. The company needs some expansion. If company needs some time from the management to expand furtherly to grow upward. I hope you like the balance sheet analysis portion and you understand side by side with me. Got to see FMVA learning side by side. Don't worry, in this Friday, we have another live session on FMVA. You have the schedule available. You would be learning with me. Thanks for watching it.